Now in this segment, we're going to look at the Strategic Petroleum Reserve, OPEC exports, what do we expect going into the OPEC meeting, and then what's happening with the U.S. and the U.S. in general in terms of the international market. So this is the schedule that was put out by the administration looking at when we're going to see some of these exchange volumes. So remember the announcement was for 50. 18 of it will be a straight sale, but 32 million of it will be a swap, which just means that you're going to take delivery. So you're going to take delivery of whatever you nominate for in terms of the delivery month. So the exchange period in terms of timing is very key in terms of December. And then when you have to return it. So then you have to say, when are you going to return these barrels? And it's going to be with interest. So again, it's just going to be a matter of, and it's not physical, payment interest, but crude interest. So you're just going to add, you're going to take 1 million barrels and bring back 1.39. So and it's just a matter of when do you want to take that return period. There's return period 1, 2, and 3. This is just going to be a matter of, where can I buy it from right now? Where can I sell it in the market? And then where can I go further down the curve to buy it back? This is where we have some issue in general because all of these barrels are sour. Now, 2 of them have already been loaded. They're gone. And not under the exchange, but under the 18 million sold. So again, there's some demand out there, but it's going to be important to look at the nominations and what period of return to see what kind of demand is there in the market. What kind of demand are we expecting, given the demand that we're seeing is on the sweeter side, not the sour side. And there's a lot of reasons for that. One, and the biggest one is cost. It costs a lot of money to take sulfur out of the stream because hydrogen is expensive, nitrogen is expensive, and then when you look at where things are in general, natural gas is expensive. So this is why the input cost to taking that sulfur out has increased. So it just makes it more expensive to process these barrels. But if they're coming in at the right price, maybe not as bad. But we've seen crude prices come off significantly following this announcement. Now, there's a lot of reasons why. One is obviously we have the new COVID variant. We don't think that is a huge issue in terms of what it's going to do to demand. There'll be some declines, but nothing meaningful based on where we are today. The bigger issue is the inflation trade. And when you look at Powell becoming more hawkish, inflation fears increasing around the world. We've had a slew of new rate increases. And when you look at the positioning, crude was the inflation trade. And not only did you have a COVID variant, you had an SPR release, you have the OPEC meeting tomorrow, you have a huge surge in crude on the water, plus you have an unwind of a trade. And because the trade was crowded, it was extended, there was a huge move down, which again kind of brings us closer to where we should be based on the underlying fundamentals. And now we think that there's a little bit more downside, but we're getting much closer to where that international market has been telling us, which is why we've been saying that there is nothing to support this price. And again, it's a paper market. There's the paper market. There's the physical market. They can disconnect for a certain period of time. But then you have a big snapback. And that snapback is always violent. It's just happens quickly. As they always say, escalator up, elevator down. And now we're starting to get into much closer to where we think there can be some stability. Obviously, we have the OPEC meeting tomorrow. Today, they're doing some more in-house bookkeeping and housekeeping. And then we expect to hear more next week. Now, coming back to the SPR release. So the SPR release they can extend some of the different movements. Just maybe we don't need as much given where prices are now. Some of the ones that were announced from the UK, Europe, Japan, they can adjust some of their releases given where prices are. But this is going to be an important thing to watch as we go into the OPEC meeting, because remember, 2022, there was already expected to be an increase in storage. And based on what is now in the water, based on the floating side, as an in transit and floating storage, there's going to be a lot available. And that's where I think they're going to see OPEC not so much cut, but just not increase by as much. So instead of it being 400,000 barrels a day, it could very well just be 250. And you might think, well, why 250? How are you coming to that number? So let's look at what OPEC has been exporting from October into November. So as we said in segment 1, you had 326,000 barrels a day additional coming from Kuwait, 186,000 additional coming from Iraq, 131,000 additional coming from Saudi Arabia. When you look at those three, you're looking at almost 650,000 barrels a day additional. And it's just coming from these three locations. And they're not struggling placing their barrels. It's West Africa that's struggling. So when you think about the demand coming forward, well, if I can place my barrels, but you can't, and then when you look at the compliance, West Africa is either 180% to 220% compliant to their quotas because they can't place barrels. So they're keeping their production capped well below their allotments because they can't sell it anyway, so why produce it? But on the Middle Eastern side, that's not the case. So they could say, look, we're going to increase our normal. You guys have more than enough wiggle room to increase production at when the market dictates you can. So I don't need to increase by 400,000. I can increase by 250,000. I can satiate the Middle East, the GCC, Russia under the OPEC Plus agreement, and I don't need to give the increase to West Africa because they're so far below their allotments. This is going to be a nice way to maybe pacify the market, give a little bit back, but we do see some increase. We don't see a no increase, and we definitely don't see a reduction in production because we don't think that there'd be enough sign off. And this is when you start looking at some of the flows in general. The UAE was down a bit, but it's going to be important to look going forward. So then when you look at what the UAE has announced, so they're raising investment in oil and gas production as the OPEC members look to boost capacity. The Abu Dhabi National Oil Company will spend $127 billion over the next 5 years, according to a recent post on Twitter from the Crown Prince. That's up from the $122 billion earmarked from the period from 2021 through 2025. The company will also evaluate plans to double production capacity of LNG to 12 million tons a year. So again, there's going to be a big push to become a bigger player not only in the oil space, but also in that natural gas space. So putting this into perspective. So two nations have added more than 1 million barrels a day since August. And this is looking at cargo. So there's always two pieces to look at. There's production and then there's exports. And exports have continued to surprise to the upside for some, which again is why we see some of those indications going into the OPEC meeting. So two nations have added more than that 1 million barrels a day since August. And here you can see Saudi Arabia and Kuwait, with the Kuwaiti oil minister likely to become the new head of OPEC for 2022. So then when you look at the Kuwaiti surge, OPEC's exports surged last month to the most since April of 2020 as OPEC Plus added supplies to the market with bigger flows to Asia, destinations including Taiwan and South Korea offsetting a drop in loadings for the bigger buyer of China. Total shipments from the OPEC members gained 326,000 barrels a day, a jump of 18% to 2.1 million barrels a day in November from a revised 1.78 million barrels a day in October. So again, you're seeing that nice little bump, and we see that continuing into December as you saw November becoming fairly strong, because November is typically a big buying month, and December you see some of that slowdown because it takes transit time and guys are already looking into Q1 for their barrels going forward. Now, when we look at the U.S. Product export, gasoline had a bounce of 279,000 barrels, right along the 5-year average, which we think is going to be, fairly stable going forward, just because we are throwing off more gasoline, so that will put more on the water. When we look at distillate had a drop of 419,000 barrels. That's well off the 5-year average by 652,000. We think that's going to remain obviously depressed. And then when we look at propane had a drop of 14,000 barrels a day, still right in line with the 5-year average. And we think instead of it being so far above the 5-year average, it's going to be much closer to the 5-year average, just above it, but not setting those new seasonal records as we have. There was a small increase in crude exports of 99,000 barrels. So we just went from 2.6 to 2.7. And that's where we think there's going to be a little bit of a creep higher versus what we initially thought, and that'll put some additional barrels on the water as we head into year end. And the reason why is because the WTI Dubai spread has gotten a bit better, which is why when we look at the OPEC agreement and we talk about what is going to happen going forward, the Middle East has been able to move more cargoes because the U.S. has been so expensive versus their available barrels. So the OSPs are going to be very important to see for January, because this is going to be a way that they could potentially compete a bit more and keep this closer to $3 to $4, because as you get it a little bit higher, you're going to see more purchases from the US, from Europe, and a little bit less from the Middle East. And that's not something they want to see, because they want to see that continuous move of barrels going from their market, especially into Asia, as the U.S. is trying to compete more into the Asian markets as well. So then when you look at Dubai, Brent Dubai, something similar, you're getting to a point where, now we're seeing a bit more European cargoes get moved, North Sea in general. We had a little bit of a tick up in purchases after seeing a huge drop last month. And those are going to be some of those benefits that we expect to see as this normalizes. But this is why OSPs matter going forward, because if they drop them, maybe more than expected, that could keep them competitive even as Brent and WTI normalize a bit lower and still keep cargoes and demand coming from the Middle East versus the US and Europe. So then when you look at gasoline exports, we had that big drop. You can see it was kind of counter-seasonal depending on where you're looking at it, but then you had the nice little rebound. We expect it just to be right in line with the 5-year average, nothing much one way or the other on the gasoline side. On the distillate export side, you had that huge drop off close to the lows from September. We expect it to be either outside the cloud or just inside the cloud. But again, distillate exports will remain under pressure. Europe doesn't want them. The U.S. is still fairly tight on demand, on supply, keeping things locked in the U.S. versus into the export market. And we do have more cargoes coming from Europe into the U.S. as we do have an increase of those imports from one to the other. And just to give you an idea of what we're seeing so far in what's coming into the U.S. November, I lost my spot with the arrivals. European gasoline arrivals in the U.S. more than doubled in the 7 days through November 25th. Gasoline arrivals more than doubled to 285,000 barrels, compares with a revised 138,000 last week. Europe diesel shipments surged to 1.6 million barrels, highest since the week ended March 18th. So again, you're seeing way more get delivered into the U.S. That's going to keep things fairly capped because, again, we're attracting it, so it's going to be difficult to push it into the market as more Asian and Middle Eastern disti also continues to move into the European markets. Ethane exports dropped off. This should have a rebound. This is some noise from Thanksgiving. You can see we've been here before and typically have a strong bounce. Exports for the U.S. trending closer to the top end of our view. Remember, we were thinking 2.6 to 2.8. We now think it'll be closer to 2.8, 2.9, especially into the end of the year as prices have gotten a bit better. And here you can see we're right at that 3 million. So we still think there'll be a little bit pull down, and that will naturally move through just based on the way math works on the rolling 4-week average as the numbers of 2.6 and 2.7 get baked into the 4-week rolling average. And then when we look at U.S. propylene exports, right at the 5-year average, we expect to see this bounce, but again, stay within the cloud and come in closer to about 1.25, 1.3 million as we see exports remain fairly stable. Now, when we look at GENSCAPE ARA crude total tank stocks, you can see that there was a huge drop off. This is the lowest we've been for 2021. It is a seasonally adjusted low, and it is a 2021 low. Now, this is that disconnect that we've been talking about between offshore and onshore. Some of the demand issues that we've seen with Austria, Germany, France recently, that will put more crude into storage. There's more than enough space. So again, even if you see an increase, it's still going to be in a bullish tint. And it's going to be a matter of when does that offshore get loaded into the offshore get loaded onshore. Then when we look at product storage, you can see that there was a pretty healthy drop across the board, especially in gas oil. We expect this to reverse this week, and then the next preceding several weeks as activity slows down in Europe and some of those cargoes that we've been talking about show up within their system, because it still makes more sense to go there versus in the U.S., just given the arbitrage, and you're seeing some of those adjustments. Seasonally speaking, coming to the lows, we expect this to rebound, but still remain fairly tight versus historics and come in closer to where we were at the end of August. Then when you look at gasoline inventories, still staying fairly stable, we expect this to grind higher. And as this moves up, we expect the spread between Europe or the arb between Europe and the U.S. to open up a bit more. We've already seen some exports increase, as we just mentioned, and we expect to see that increase over the next few weeks. Fuel oil still remaining very healthy, and there was that arb that was moving from Europe into Asia. That has tightened a bit as demand has slowed down, and this is going to leave a bit more fuel oil in their system and again open up some recracking and some inherent movements between the different systems. So now we turn to Singapore, and as we were saying, we expected to see a fairly strong bounce off of that 40 million level, and we've added about 2.3 million since we made that call. But as we said, we expected it just to be along the 15-year average, not this huge bounce, but a bounce. When we got just below that 15-year average, we expected to see that bounce and move pretty much in line with where we were on a historic level. So the good side of that is middle distillate continues to drop down. The negative side of that, we expect to see some of that reverse higher, but resid and light distillate remain fairly flat. So again, the next increase of storage is going to be driven by middle distillate as light and residual fuels struggle to find a home, given how some of the demand cycles have changed. And here's when we look at light distillate, as we were expecting, we thought we were going to have a fairly strong bounce once we got below that average. We expect to see this continue to have slightly higher highs and slightly higher lows. So it's not going to be this huge increase, but it's going to be a steady move up because, again, it's just timing. So you will see increases and then decreases. It's going to trend up and get closer to about that, just below that 12 million, closer to about 11.8 on average on the light distillate side. On the middle distillate side, you can see that we had a big, healthy move down. We expect it to stay below the 15-year average. As we said previously, we didn't expect this kind of drop. We expected it to just kind of waffle back and forth, but below, again, in still a bullish backdrop. So here we expect some of this to come back, but still remain with some bullish nature, while resid, on the other hand, had a nice spike. And this is showing some issue with that gas to oil conversation, because the residual side is, again, looking at marine fuels, high sulfur fuel oil, and we're just not seeing a whole lot of demand right now, which is, again, putting more in storage. And we expect this to continue to trend higher and come closer to the highs from the beginning of August. Now, when we look at loading schedules, here you can see Nigeria had a huge drop-off in December. So when you look at what was expected in December, a lot of that has been moved into January, sorry. So Nigeria still has about 10 to 15 to sell this month, which is fairly normal. And so you could say, well, it's positive because they have a normal amount to sell, but then it's an abnormal because they also have a much lower slate to sell, to put into the market, which is a bit concerning. But again, depending on what side of the fence you want to sit on. Russia is at about 3.95 million. We expect that to get closer to about 4 million by the end of the month. And Norway is still remaining elevated. And then as we look into January, Nigeria is back at 1.5. Angola is moving in closer to about 1.2. And we continue to see that be fairly stable overall. But we do expect more capacity to come into the market in December as Libya adds about another 1,960,000 barrels to December, as they've already announced, which again just hasn't been reflected here. As you can see, they did complete their work on the pipeline, which again brought back more capacity and will keep things fairly stable. And then now just looking at some of the commentary, West Africa's oil exports to Asia in November are set to decline month on month on lower shipments to India and a dip in loadings for China. Only partially offset by flows into Indonesia. 59 cargoes are due to load for Asia in November, equating to about 1.87 million barrels a day, which is down from about 1.99 million in October. And then when we look overall, so Urals in general, volume of Urals to Asia this month, which is speaking in November, was the lowest since March, compared with 17-month high in October. So again, you're seeing some of that slowdown, but it's because they're picking some of their spots, as we are seeing an increase in flow, and a lot of that is coming from a floating storage already out there, or from the Middle East, which again is something that we want to consider going into the OPEC meeting. So then, when we look at Fujairah, light distillate and heavy disti resid has had a nice bounce, but again, middle distillate is in that bullish backdrop. Total oil product stocks in Fujairah were reported about 18.1 million, and total stocks rose 1.84 million barrels with overall increases. This is a reversal of last week's decline when stocks reported a 20% drop. Light distillate, including gasoline and naphtha, had a build of 38,000 barrels. This is a reversal of last week's large 1.569 million drop. And if you look at where we were before Thanksgiving, we were just below 4. We expected to see a fairly steady grind higher. We think that's going to continue as the demand for light distillates has dropped off just a bit. And as Asian gasoline market remained largely steady this week, with industry participants looking for directional cues amid diverging supply-demand factors. However, the new Omicron variant of the coronavirus weighed heavily on the outlook. Again, that's where we see some of those some delays in purchases, which is just going to show up by more stuff and ending up in storage. Now, middle distillate, including diesel and jet, fell 945,000 barrels. Which is a continuation of last week's drop of 755,000 barrels, hitting the lowest level since March of 2020. Asian middle distillate markets maintained constructive this past week, but the outlook is subdued given the issues not only on an economic level but also on an Omicron level. So destocking activities during the year end and expectations of tapering demand in the key China markets could see Chinese suppliers offload surplus barrels in the spot market, because we have seen a pretty steady increase in Chinese storage. And remember, they put a cap on diesel exports, and we do expect to see some of those exports come back into the market in December as they try to balance what they think they need for winter and what is currently available. Stocks of heavy resid increased by 2.747 million, which brings us to which is a reversal of last week's decline of 1.716. So you saw that big increase. The Asian low sulfur fuel oil market was likely to sustain some strength going into trading January loadings, but downstream low sulfur oil demand in Fujairah has stayed relatively flattish, but still firm, as you've seen some increase in demand. But we will see a bit more demand for shipping, which will keep heavy disti resid fairly stable at these levels. So we do expect an increase in middle distillate, but still fairly strong, but a bigger increase in light distillate. So then when we look at global crude on the oil on the water, you can see that we're at a seasonally adjusted all-time high and a 2021 high. So the global crude on the oil on the water is at a record, and that is something that we think will continue as more of these cargoes end up in the water and get left on the coast. So here's oil in transit. You'd say at a 2021 high, and now at a seasonally adjusted, just above that top of the cloud. Again, we think it's going to continue to move up over the next 2 weeks. Floating oil storage dropped, still fairly stable. We expect to see this again kind of bounce around. We could get one more drop before we see the increase. It depends on how quickly these barrels show up in Asia. But this is something where when you look versus the last few years, we expect this to follow 2016 pretty closely when you look at where we sit now versus 2020. Then when you look at Brent time spreads, you can see how abrupt that drop was over the last 2 weeks, week and a half, I should say. And now we think that things are going to kind of hold right around these levels and probably move closer to about 37 over the next week or two. Then when we look at run rates in out of the teapots, as we were saying, we've seen a drop in teapot activity and an increase in the state-owned enterprises or the SOEs. And we think that's going to balance out right around here without too much additional increase in the SOEs, with teapots kind of hanging around that 2019 level, as you can see, compared to that yellow line at just below 70% utilization rate. Now, one of the things that is concerning is even though we've had a pretty steady drop in crude prices, we've actually had a steady drop in refinery crack spreads. And realistically, the crack spreads are based on what am I buying my crude for? What is it going to cost me to process it? And then what can I sell my product for? And as the price of oil comes down, that is obviously a huge input cost, but we still see elevated costs for operating, and we're seeing some pressure on the demand side. So you're actually seeing crack spreads come down pretty aggressively, and with some of them in Singapore now going negative, especially on the light hydroskimming end, which is why we expect to see some additional increases in the on the lighter end, especially when we think of light distillates in both Singapore as well as Fujairah, as we see this, moving closer to the 5-year average on the hydrocracking side. Because remember, the shift was very aggressive into diesel, and by doing that, you obviously naturally create gasoline. So now gasoline and diesel is actually above the demand levels, which is where we're starting to see that come in and weigh on crack spreads a bit more. Now, the same thing is playing out in Europe, just not as aggressively as in Singapore, but you are seeing these pressure points as we expect to see a lot of this storage start to increase again. And this is also playing out in the Mediterranean with, again, the lighter ends going negative once again, which I think is going to put additional cargoes on the water to try to maintain some price. China crude supertankers are back to the highs. We think this continues to shake off some of the seasonal declines, because remember, November is typically when they purchase and then they stay elevated. Instead, they came in a bit later. So we do expect this to remain elevated and come closer to the top of that cloud. As Asian floating storage, you can see we're right down to the low end here, and just when you think about this movement, the floating storage is right back to 2016 levels. The Asia could drop one more time before it bounces, but we expect it to be closer to the 20, essentially close out right around where we closed out 2020. As these cargoes show up and you have some of those delays coming from offshore to onshore. And especially as the teapots slow down and the SOEs, even though they've ramped up, are still relatively capped. And now when you look at the North Sea is right at the 5-year average. We expect it to kind of stay there, if not trend up a bit. It's just going to be a matter of how quickly are some of these cargoes sold into the market, as there has been a slight acceleration of sales. And there is still opportunity to move onshore in Europe. So this could keep us either right at the 5-year average or just below, but again, right around these levels. West Africa has started to see some sales increase. And you are seeing a big decline in loadings for December out of Nigeria, which again is fairly stable here, which is why they're trying to sell a lot of this excess that is sitting in the water. Now on the Middle Eastern side, things are getting a little bit elevated. So this is going to be one to watch, and this is what they're going to watch closely as they go into tomorrow on what will the OPEC agreement be in terms of new production versus just either maintaining or only increasing a half of what they expected, which, as we said at the beginning, is a bit more likely. But again, you're seeing some of these cargoes get stuck, which is why I think OSPs are going to be so important. And now when you look at Europe, right at the 5-year average, there's that timing delay again. We expect it to stay right around here. And now when we look at crude stocks in Shandong or the teapots, we're just above 2019 levels. China's diesel stockpiles rose 1.9% over the past week to about 15.54 million, the highest level since October. Inventories are at 35% capacity, with gasoline stockpiles rising slightly and to 14.68, right at 42% of capacity. And at the same time, you can see that on a fuel oil side, they're right back to 2021 highs, and really, seasonally speaking, the highest of all time, seasonally adjusted of all time. And this is just a matter of making sure there's enough available for winter. And now that they're getting to these elevated levels, we expect to see some of these cargoes coming back to the market, coming back on the water, which again is just going to make a slightly saturated market a little bit worse, and you're just now starting to see that show up in the data. So that's something that we expect over the next 2 or 3 weeks to reflect in the 3 charts that we showed at the beginning of the month, at the beginning of segment 1. So if you have any questions, you know where to find us. You can find us in the comment section or at MarkFNY. And again, thank you for staying with us, and we hope you have a great day. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.